The number one concern I hear from veterans using their VA loan is not the down payment, it's the closing costs. I'm Jason Wood, and today I'm going to break down exactly how to address closing costs on your VA loan or how to just avoid them completely. The VA loan is famous for having no down payment, but that doesn't mean that there are no closing costs associated with doing the transaction. Let's clear this up, and more importantly, let me show you how you might be able to eliminate this completely. Let's start with the basics. Most closing costs on a VA loan range anywhere from 2% to 5%, depending on who all the third parties are and whether or not you're buying your rate down or how that component of it looks. So on a $400,000 loan, that could be anywhere from $8,000 to $20,000 in closing costs. Here's how that breaks down. VA specific costs. What I mean by that is the VA funding fee. So depending on your usage and or down payment, that VA funding fee can range from 1.25% to 3.3%. Lender fees. Typically, lenders will charge a fee for processing and underwriting in their fee sheet. The days of lenders charging points for their revenue are fairly long gone. Sometimes you'll see it, but it's actually pretty rare to see that nowadays, where you're going to see a lender charge an origination fee. Third-party fees. This is going to include things like the appraisal, the recording fee, and the title company or settlement agent costs. The title and escrow fees, depending on your loan size, can range pretty wildly, anywhere from $1,000 to several $1,000s, and usually they're congruent with the size of the loan. So the larger the loan, the larger those fees are going to end up being. Then there are prepaid items. These are things like property taxes, home insurance, and even HOA dues if you're buying a house with an association. The total can feel like a lot, but you've got more flexibility than you probably realize in handling these fees. So funding fee exemptions. Most veterans with a disability rating of 10% or higher are exempt from the VA funding fee. This is a huge savings because the typical funding fee, if you're using your VA loan for the first time, is 2.15%. So 2.15% on a $400,000 loan is about $8,600 that gets tacked into your closing costs. The only benefit that there is with the VA funding fee as we compare it to other closing costs is it's the only one that can be financed. Meaning if our loan is $400,000, we can stack that on top. The other fees like appraisal, title company, your prepaid fees and stuff, that cannot be stacked on top of the loan. That has to be paid at closing by somebody. You might also qualify for the VA funding fee exemption if you're a surviving spouse of a veteran who died in service or who died because of a service-related situation. You're currently receiving VA disability or you have a pre-discharge claim, you could be exempt, or you receive a memorandum rating before closing, or even Purple Heart recipient can all be exempt from the VA funding fee. So there are smart ways to pay for your closing costs on a VA loan. So let's talk about those options. You have quite a few. Option number one is a seller concession or a seller credit. This is where you negotiate the purchase at the very beginning before you open escrow, where you negotiate that the seller is going to provide a credit from their proceeds. So the money that they're going to get net after they pay their mortgage and they pay their closing costs, you're basically asking for a piece of that to go towards your closing costs. This is a very common way that most VA loans progress, where they don't have any closing costs due out of their pocket when they get to closing. Oftentimes you talk to vets who purchased a home many years ago and they've forgotten the mechanics of how their deal worked. They just remember they didn't pay for closing costs. So they might tell you there's no such thing as closing costs on a VA loan. Probably their memory is a little bit foggy though. So option number two to take care of your closing costs could be a lender credit. That's right. The lenders can actually pay for your closing costs. Now, this comes at a little bit of a cost, however. So typically, we're all hunting for the lender with the lowest interest rate. Well, if we want the lender to pay for our closing costs, we gotta be okay with not getting the lowest interest rate, because in order to receive that credit from the lender, you're gonna have to go higher in interest rate in order for the lender to step in and provide that credit. See, when a lender pulls the rate sheet on your specific scenario, and everybody's scenario is unique, so your interest rate on your scenario might be different than your friend's who's buying a similar priced home. But when we pull that rate sheet, we see the very bottom of the rate sheet all the way to the top of the rate sheet and every 0.1% interest rate in between. Every interest rate has a corresponding either cost or credit associated with it. So if you wanted a lower rate, that's going to increase your cost. If you're willing to take a higher rate, you may step into the world of receiving a lender credit for that rate. Now, the third option, which is kind of a combination strategy of financing the closing costs and also getting the seller contribution to cover your closing costs. This is where you could actually come in a little bit over the asking price, which I know might sound counterintuitive, but what we have to remember is when we're making an offer on a home, it is a little bit of a poker game. There's some psychology that needs to be played there. So while we as the buyer want everything to go our way perfectly, we got to remember there's somebody on the other side who also has to agree to that and accept it. And every seller has their eye on what their net proceeds are going to be, and they probably have a little bit of wiggle room. What we don't know is how much wiggle room they have. And if we cut them too deep, the opportunity for them to say no to you is much higher than if we're a little bit more amenable. So one of the ways that you can do this is to come in a little bit over the asking price. Nothing crazy where we're going to have an issue with your appraisal, but it could be a couple of grand higher because now we're playing to the psychology of the seller. We're coming in a little bit higher, but still asking for the amount of credits that we want in order to make the deal work. I'll share with you guys a recent example of a huge success story. I had a client who was purchasing a home in Jacksonville, Florida, active duty, buying a duplex, and he was able to negotiate a 5% credit from the seller. So what we did is we used this to do a 2-to-1 temporary buy down and pay all of his closing costs. So essentially, the only money out of pocket he had for the whole transaction was just the home inspection. And then he was able to get his earnest money deposit refunded to him at closing. And he started out with an incredibly low rate, almost similar to the rates in 2020 and 2021. And of course, the final option for taking care of your closing costs is just to pay them out of pocket. And if you have the cash, sometimes the deal is going to necessitate that you pay it. Not every situation is going to work where going up higher in interest rate with a higher payment and getting a lender credit is going to work. And oftentimes, you may not get a seller that's willing to cooperate with you, but if that's the house that you got to have, then you also need to be prepared to potentially have to pay these closing costs on your own. What I tell people all the time is prepare for the worst and hope for the best. And preparing for the worst would mean you're paying the closing costs out of pocket, and hope for the best that we get the seller to pay for all of them. Now, that doesn't mean you have to accept a seller's counteroffer if they're saying no to your request to pay their closing costs. You can move on and you can go find another house. That's always an option that you have, so you don't have to get completely married to the fact that one seller may say no and you're stuck having to pay them. You could always move on and find a different home. So let's see how the VA loan stacks up compared to some of the other loans out there with regards to closing costs. Now, like I mentioned, the VA loan has closing costs that range usually anywhere from 2 to 5%. And a lot of that largely depends on the funding fee percentage, and that's based on whether or not you have a disability rating to have an exemption, or your usage of the VA loan, and or your usage and down payment on that home. All of those can affect what the VA funding fee is, which is why there's that range of 2 to 5%. On a conventional loan, you have the same range of closing cost fees of anywhere from 2 to 5%. But the other kicker that you have with conventional loans is you have a down payment. And if you have less than 20% down payment, you're also going to have mortgage insurance, which is an additional cost to you monthly. And third, on top of that, you're going to have a higher interest rate than you would in comparison to a VA loan. So your total cash out of pocket on a conventional loan will be higher than it would be on a VA. On an FHA loan, you're also going to have a range of about 2 to 5% in total closing costs. Now, the FHA has its own version, you could say, of the funding fee. They call it an upfront mortgage insurance premium. It's 1.75%. So that doesn't fluctuate, but that can also be stacked on top and financed similarly to the VA funding fee. And that's an additional cost. On an FHA loan, you can put as little as 3.5% down payment, but you will also have monthly mortgage insurance. So there are some cost differences between these three loans, and the conventional and the FHA loans, both of them will have mortgage insurance. At least the conventional will if you have less than 20% down payment. So another real life example, I recently purchased a home where I went to the seller. I went over the asking price because I knew how much credit I wanted, and I had a feeling if I went straight in and asked for my credit, they would just say no to my offer completely. So I went over the asking price and asked for my seller credit. So they were only taking a small haircut compared to what the total credit was. And that allowed me to that allowed me to pay for all of my closing costs as well as get the 2-1 buy down. So now my start rate for the first year is 2 percentage points lower than where I would have had to be with just a traditional VA loan 30-year interest rate lock. So what's next? Request your certificate of eligibility, and you can come to me or any VA lender and we can pull that for you if you don't know how to take those steps on your own. And see if you're exempt from the VA funding fee. That could be an important one. You may not even realize you're exempt. That could be a huge benefit. And talk to a VA loan specialist who can actually help you in your strategy for structuring and putting together your home purchase to determine if lender credits are available, how we would structure it for a seller credit, what if there was some combination of some of your money, some lender credit, and the seller credit. So you need someone who can be able to strategize this for you and walk you through each of these metrics. If you're ready to get started or just want to see kind of what the numbers look like, go ahead and click the link below to schedule some time with me, or you can visit me online at valoanguy.us. I'm Jason Wood, the VA Loan Guy. Aim high, and let's get your closing costs down as low as possible on your next loan.